Hey guys, had a little interest from the group on this short-term calendar spread. I studied with Sheraton for a couple years, and one of the great trades I learned there was the calendar trade. And what I've found is that as long as you're keeping an eye on volatility, it can be a powerful trade. And in many ways, I think it's even a little more flexible than the condor because really, when you start doing it short term, as I'm going to show you, volatility or vega risk starts to get smaller and smaller the closer in your trades are getting to expiration, especially in this example. So, first, let's look at the VIX. So here we have a graph of the VIX, and you can see I have my monthly high level here, my monthly high, my monthly low. And so we are in March now, and the previous month's high was 33 in the VIX. The low was 19. So we're right now at kind of mid-range. We're at 25 right now, and the reason why I point that out is because that can be um, obviously you don't want to start a short, you don't want to start a long vega trade way up here at these high levels. So right now we're kind of mid-range in the volatility range. So we can put on a calendar with no problem. Um, all right, so let's look at the expiration, the option chain and the SPX, and going into next week, if you were going to put on a short-term calendar, the way that we looked at it was like you're using these expirations, these right next door to each other expirations. So going into Monday, if you want to do a short-term calendar, you're looking at the 5 and the 8. Or in this front end month can be anywhere from 3 to 5 days to expiration, and then you're just buying your long in the next expiration. Okay, so what your front end month is 3 to 5, and your long month is just the next month, the next week's expiration. So let's look at that. So that would look like this. Let's do the call side. Typically, the call side is a little more liquid. So we're going to look at it from that side. And we're going to buy a calendar. Okay. Obviously, it's Sunday night, so market's not open. But this is what your expiration would look like. So your short would be here in March 12th. This expiration, and then the long is the very next expiration of March 15. All right. So you're buying the next one. Let's do one contract here. And we're going to analyze that. I have some other things going on. Let's take those off. And okay, and just gonna reset like that. Okay, so this is what if we go to Monday, this is what we're looking like. Today's the 7th. We are starting off very delta neutral. Our risk with one contract is about $400 debit. So the goal of this trade is to get a 10 to 15% return on risk. So your max risk here is 400. So you're trying to get out at $40 to $50 on that. So that's 10 to 15%. Sometimes they go up to sometimes they go up to 20, but most of the time its exit criteria is 10 to 15% up or down. So you don't want to lose more. You see how when you start getting out to these break evens, you're losing about $80. So let me just calculate that 1 second. So our max risk out here is 420, and at break even you're losing like 90, 80 to 90. So let's say 85 divided by 420. Your max loss at break even is 20, and that's if you put it on that day. They don't like to go more than 15 though. I noticed that it's always 10 to 15% up or down. So you would exit on more like a $75 loss. So let's look at the Greeks here. So all right, so the Greeks here at the money for 38.42. Your theta that's coming in here is $100 a day. The Vega is 44. So see, that's why this is such a powerful trade, because the Vega compared to theta risk, the theta is just outweighing the Vega so much. Even if you do have a fluctuation in volatility, the theta is just going to make up for it over the next day or so. They typically like to put this trade on a Tuesday or Thursday. They aim to be in this 1 to 2 days max once you put it on. So, best case scenario, market stays the same. It's Monday and volatility doesn't change. If you could get, that's why a lot of times, you see the curve is just growing extremely fast, because theta decay is happening. The rate of decay is happening extremely fast. So many times they're out of this trade the same day that they put it on, and they are constantly redeploying with that same rule. Like, they'll take it off next day. If they're selling the 3 to 8 days, buying the next expiration, same process. Exit at 10 to 15% max profit, exit at 10 to 15% loss, and then just come and play again. Typically, they're in this trade no more than 2 days. Many times it's 1 day or less, same day you're exiting. Very powerful trade. I probably had an 80, and I'll post my results at some point, but it's been like an 85% win rate. The execution is great because we're in SPX, and I just set my automatic exit as soon as I put the trade on. And it's simpler than the Iron Condor from my perspective, because you're only dealing with 2 legs, you're not dealing with 4 legs. I really like this. I hope you guys try it out in the group, and let me know what your opinion is on this, and we can go from there. And also, it's great as a add-on.